Gold just had its worst quarter in over 10 years. Not a bad week, not a rough patch. The worst quarter in a decade. And I've spent the last 20 years tracking exactly this kind of move, which is why so many of you have been messaging me over the last 5 days asking one question: what is actually going on? Okay, no more setup. Let's jump straight into it. I know a lot of you are panicking right now. I'm not. And I get how that sounds, like the thing every analyst says right before he gets proven wrong, but I've actually been buying this week. Not backing off, not waiting for the bottom, actually adding to my position. That probably sounds like the opposite of what the headlines are telling you to do. It is. And that's kind of the point. When something moves this fast and this violently, the instinct is to jump straight to the scariest possible explanation. So let's actually walk through the mechanics of what happened, because once you see it clearly, most of that panic just evaporates. Something real did happen here. It's just not the something most people think. So where does this actually start? It starts with the Fed. There was a stretch of commentary that got read as more hawkish than expected. Rates staying higher for longer, and gold doesn't love that environment because gold doesn't yield anything. When real yields tick up, some money rotates out. That's the surface story. And it's the one every headline ran with this week. But that's not the whole picture. A normal rate-driven pullback looks like a slow bleed, 3 or 4% over a couple of weeks. What we actually saw was a cliff. And a cliff like that isn't retail investors calmly reallocating their portfolios. That's forced selling. So the real question is, who's forced to sell? And that's where it gets interesting, because a big chunk of this was bullion banks. For anyone who hasn't heard that term, bullion banks are the big institutions that make markets in physical and paper gold. And a lot of them run leveraged positions that get triggered automatically once price crosses certain levels, stop losses, margin calls. The whole mechanical apparatus. Once gold cracked one key level, it didn't just dip. It triggered a chain of automatic sell orders that had nothing to do with anyone's opinion on inflation or the dollar. The machine sold because the machine was built to sell at that price, not because a room full of humans suddenly decided gold was worth less. So that Fed comment was really just the domino that got knocked over, not the reason the whole row fell. And here's the second order effect almost nobody's talking about. Once that cascade hits, it doesn't stay contained to gold. It bleeds into silver. It bleeds into mining stocks. And it spooks retail buyers who see red everywhere and assume something is fundamentally broken. So you get this strange feedback loop where a mechanical, almost technical event gets reinterpreted by the public as a narrative event. Gold is losing its safe haven status, when really it was leverage unwinding at 3 in the morning while most people were asleep. Let me pause the analysis for a second, because I want to tell you why weeks like this genuinely don't rattle me. When I was about 9 years old, my grandfather gave me a small stack of gold coins. He didn't explain much. He just said, hold on to these. Don't sell them when you're scared. Only sell them when you actually need to. I didn't understand it at the time. I just thought it was cool old money. I still have every single one of those coins. I haven't sold a single one in over 20 years. Through every crash, every gold is dead headline. All of it. And honestly, that's probably the real reason a week like this doesn't shake me. I watched that original stack sit through worse. Now let's bring it back to right now, because I don't think this is really a story about the Fed at all. Here's the bigger frame. A lot of people treat the daily gold price like it's some pure, independent market reflecting supply and demand for a shiny metal. It isn't. It's overwhelmingly a paper and derivatives market first, and a physical metal market a distant second. I use something with my clients I call the 90-90-90 rule. Roughly 90% of daily gold trading volume is paper contracts. Roughly 90% of that paper never touches actual physical delivery. And roughly 90% of the price moves you see in any given week are driven by that paper positioning, not by anyone actually buying or selling a real bar of metal. Once you understand that, a crash like this stops looking like the world decided gold is worth less and starts looking like exactly what it is, a leveraged paper market doing what leveraged paper markets do. And I want to say this directly to whoever's watching. A lot of you bought gold near the top a few months ago, got caught up in the excitement, and didn't fully understand the mechanics of how this price actually gets made day to day. You're sitting there right now looking looking at red, and feeling like you made a mistake. You probably didn't make a mistake. You bought an asset without understanding its short-term price mechanics. That's fixable. Panic selling into a mechanical unwind, that's the actual mistake, not the original purchase. This actually connects to something I talked about a few months back, a study that's over 140 years old on how gold behaves during financial panics. I think it's the exact reason I can sit here and tell you I'm calm. There's research going back roughly 140 years looking at how gold behaves during and after banking panics and currency stress events. The pattern holds up remarkably well. Sharp, fast drawdowns happen, sometimes brutal ones, and they're almost always followed by a recovery that pushes beyond the previous high once this underlying stress doesn't simply disappear. I'll give you a personal example. In 1987, I remember my father, who held physical gold, getting calls from his broker urging him to sell during the crash. Everyone was in full-blown panic. Stocks were in freefall. Gold dipped alongside everything else at first because people were selling anything liquid to cover margin calls. My father didn't sell. Within about 18 months, the people who held through that chaos were in a completely different position. The people who panic sold during the worst week locked in those losses permanently. So, the lesson is simple. If you're checking the gold price every 5 minutes during a week like this, you probably have too much exposure relative to your actual risk tolerance. That's not a market problem. That's a position sizing problem. Fix the position size, and the 5-minute refresh anxiety usually takes care of itself. Now let's zoom out a little. Gold crashing this hard doesn't happen in a vacuum. It's usually tied to something bigger happening with the dollar. At the same time, gold is getting hammered. There's a massive structural shift happening around stablecoins. With the Genius Act shaping how dollar-backed stablecoins get issued and regulated, the United States is essentially creating a new enormous source of built-in demand for dollars and U.S. treasuries in digital form. That's a dollar story unfolding at the exact same time as a gold story, and the two are more connected than most people realize. And this isn't just a US story either. Look at Japan right now. Decades of ultra-low interest rates are finally cracking under the weight of massive debt, and the yen is under real pressure. Look at the UK. People forget how close Britain came to a full-blown financial crisis during the Liz Truss period, when the gilt market nearly seized up in real time. What pulled it back from the edge in those final hours was something almost nobody watching the news even knew existed. That part, what actually saved it, and why it matters enormously for what's coming next for the dollar, is exactly where we're headed next.